to my channel. If you guys want to get more information about stocks, please subscribe to my channel. I'm going to be doing more videos like this. And if you like this kind of information, leave some comments down below and subscribe and like, and I would greatly appreciate it. So today we're going to be talking about Verizon Communications. And I've been looking at this stock for a while now, and I believe, and along with other analysts, believe that this stock is currently undervalued. And I'm going to show you guys why I believe the stock is undervalued by doing some evaluations on their earnings per share and also doing some dividend analysis. So let's get right into it, and I'm going to show you guys what I'm talking about here. I'm going to go to my Excel spreadsheet here to show you guys how I'm doing my earnings per share. So the first thing I did was I got the earnings per share of $5.13, and if you guys look at their analysis here, you will notice that they have their high estimate of $5.13 going into 2021, and we basically have a few months left before their fiscal year closes, which is, December 2020, and January begins their new fiscal year. So the high estimate of 513 is the analyst rating for their earnings per share. And as far as their sales growth is concerned, they've been lagging behind for a little bit here. Back in September, actually the current September, they have a 3.7% of a negative return growth, and then they're projecting that they will get a little bit better of a negative 1.3%, and then the full current year of 2020, it's negative 2.9, but they're projecting that they'll have a positive growth of 3.5% going into 2021. So Verizon said that its earnings on a non-GAAP adjusted basis was $1.18 per share. This was only 3% lower than a year ago. And Verizon generated higher cash flow. So for example, the first half of 2020 cash flow from operations of 23.6 billion is an increase of 7.7 billion from the first half of 2019. And this represents a huge increase of over 206%. Moreover, its free cash flow in the first half was 13.7 billion, and it's an increase of 74.1% year over year. And so I believe that they're going to be projecting higher earnings, and so this is a pretty good number here, 3.5%. But what I'm doing is I'm taking a little bit more of a conservative growth surprise rate of 2%. So we have an earnings per share of 5.13% with a 2% growth surprise rate. So my earnings per share is 523, and the PE ratio of 13. I'm using the current PE ratio of what they have right now based on the trailing 12 months. So if you look here, it's 13.1%. Their forward PE ratio is 12.25, but I think they should be able to keep that up. So I'm using the high of 13 as their PE, and my high estimate is $68.02, which is a 11.1% increase from where we are currently of $60.48. And my low estimate is 478 for their earnings per share. So if we go to their earnings per share on the low side, they're currently projecting $4.78. And if we use 478 with a 2% growth surprise rate again, their earnings per share is 488. And again, with the 12.28 PE ratio, the low side of this would probably go to $59.87, where we are seeing a 1% decrease from the current value of the stock right now. And if we use a 495, which is an average of this, and again the average over here is 493, I'm just putting 495 with a 2% growth surprise rate with a high earnings per share of 505 with a 12.28 PE ratio, then we're getting $62 for the current value of the stock going into 2021, which is be around January, February. So again, you're getting a 2.5% increase from where we are right now. And I also want to let you guys know that I also did a dividend yield analysis on this. And so this is the formula here, the fair value based on the dividends is you get the dividends and then you multiply that by 1 plus the growth of the dividends, which is 1 plus G, and then you divide that by the rate of return that you're requesting. So in our case, I'm requesting a 6% rate of return on my money, and then you minus that with the growth rate again over here. So that's the formula, guys, to use when you want to do a dividend yield analysis. So what I do is whenever I plugged in the numbers using all the dividends, so what I did is I go to Seeking Alpha, I got all the numbers from here. The annual payout rate is 251, and then you have a growth rate of 2.51% for 5 years, and they pay quarterly. And if you look at their history, they've been paying dividends fairly consistently at 56 cents and then 57 cents, and it's been rising 59 cents. And then when you look at 2020, 61 cents here in January, 61 cents. So they've been pretty consistent, and they even increased their dividends for their October 7 amount is 62.7 cents. So that's pretty good for a stock like that going through this. And plus, don't forget that there's a 5G announcement coming out, and I think that will also boost the stock further. So without further ado, I'm just going to go ahead and plug in the numbers here. So we get the fair value by getting the 251, which is the dividend, annual dividend, and then you multiply that by 1 plus the growth rate, which is 2.51 or just 2.5%, and then you divide that by our required rate of return of 6% minus the growth rate, again, the 0.025. So the 2.5%, you have to divide that to get 0.025 and 0.06. And then when you do these calculations, you get 257 on the top number. You divide that by 4% on the bottom. So based on our fair value price, just by using the dividend yield analysis, we're getting a price of $73.51, which is a very strong, solid number. And it's even higher than what I'm doing by just the earnings per share analysis of $68.02 for the high end and $59.87 and 62 on the average side. So based on the solid earnings of their dividends, it looks like they are growing very, very strong. And I think that there's a high possibility that this stock is completely undervalued. And I think that there's momentum and there's a strong case to be made that the stock can go up. Of course, in the short term, it could go down depending on what's going to happen Tuesday. But it looks like this stock has some more room to grow, and it's pretty undervalued. So if you look at the chart here, we're looking at, let me see here, let me do like a 2-year line here. So 60.48, so it went very low, it went down to 51 down in March. So it's very bullish, as it says right here, and then the support is 56.75 or 76, and then the resistance is 61.19. But I think that it's going to break through that resistance line very soon, and it should go much higher than where we are right now. But again, this is just my analysis. I'm not a financial analyst. I'm not recommending buying or selling anything. I'm just doing an analysis to see what you guys also think about this stock. I would be highly interested to know what you guys think, if you guys are bullish on this stock. But the dividend yield is also very good. It's very healthy. I like the fact that the dividends are growing year over years for 7 years in a row. It's been growing, and it's at 4.15% yield. So guys, that's a very good number there. So let me know what you guys think. I would really love to hear from you guys. And if you guys like this video, please like it, subscribe to my channel, and I'll see you guys in the next video. Thanks for watching.